Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax. And today's video is around the practicalities of running an employee benefit trust. Why would you use it? What do you need to think about? Should you set up an employee benefit trust for your family investment company? Okay, so welcome back. So today's video is around what are the practicalities of running an employee benefit trust. Well, it can be used for a wide variety of assets. So it's usually utilized for large companies who want to set up employee benefits without it having a major taxable impact upon their employees. So people can put in millions of pounds, for instance, for setting up sports grounds and things like that for their companies. But it can also be used by smaller companies. Now, we utilize it mainly for inheritance tax purposes, and usually the assets that go into a family investment, into an employee benefit trust, are the shares of a family investment company. So, like any other discretionary trust, the shares can be passed to an EBT using something called holdover relief. This effectively means that the capital gains that's embedded in the share portfolio, this is covered by how we deal with family investment companies in the first place, but for property landlords specifically, there's usually a lot of capital gains tax buried in their shares, and therefore the capital gains tax can be deferred for 125 years, which is the length of the employee benefit trust. So really it's very highly beneficial for professional property landlords who may have accumulated massive capital gains tax liabilities by owning properties for 20 years or so. So the directors who pass the assets to the EBT must not benefit by getting the shares back again. It makes no sense for those directors are usually the people who set up the company in the first place and who own the properties in the first place. They pass the shares of the company to the EBT and they mustn't take them back again. Otherwise that would be a circulatory regime and therefore that would fail as far as HMRC are concerned. However, all other employees must be able to benefit. Now, these are usually only the family members, so we say ideally it's only bloodline, your children, your grandchildren, your great-grandchildren who are allowed to own shares and not anybody else. Now, in some cases where you've got people with large property portfolios, for instance, and they need other people who are helping manage the company, we're saying set up a separate service company which then deals with those employees, and therefore there's no issues with the employee benefit trust. Now, with an EBT, we're not limited by the 325,000. You can put in any figure you like, 20 million if you've got that much in shares, frankly. So there is no limit to the amount gifted, and therefore for people with high value property portfolios, this is really sensible because you're able to get it out of your estate. The other benefit is when you make the gift, it's immediately outside of your estate. There is no 7-year waiting period. So for those clients, for instance, who already have their properties in a limited company, we can change it into a family investment company a week, then set up the EBT, and it's immediately outside of the estate. So for some people, that's highly beneficial. The other major benefit is that the normal regime of periodic charges, which is on normal discretionary trusts, in other words, you pay a 6% charge for the assets over 325,000 every 10 years. That simply doesn't apply to employee benefit trusts. Now, if you've got a big CGT issue of the family investment company, in the employee benefit trust, what you can then do is to pass the shares back to the employees, which are family members, usually the children and grandchildren. Well, obviously they have to be over 18, otherwise they can't be employees. Then the CGT is levied on the person getting the shares. So as long as that's fully declared, and ideally they would use their capital gains tax allowances in any given year and possibly some losses, then slowly but surely the capital gains tax can be alleviated over years. And because of the way we set up growth shares within family investment companies, any growth in the properties is then not liable to that CGT. So it's the capital gains tax that's embedded in the shares on the original setup of the company, and that figure stays fixed, and then we slowly get rid of it using the CGT allowances of all the beneficiaries, right? But it can't be anybody under 18 because they have to be employees. Okay, so that's how you use the recipient's personal CGT allowances, and basically over many years the original CGT liability can be either entirely wiped out or significantly reduced. But if you think about it, if you defer a capital gains tax liability for 50 years, then the real value, in other words, the amount of money that assets can be bought from that liability, is also significantly reduced just due to inflation. So those are some of the practicalities. Main points are benefits are capital gains taxes deferred for a long time. You can use personal allowances of the employees, but the people who set it up in the first place must not benefit from that employee benefit trust at all. Okay, that's it. Hopefully you found that useful. Thanks for listening, and bye for now. Bye.